Hi, hello, welcome friends. In this video, I am going to discuss about fund accounting classes. So, where we have started fund accounting classes, and after that we have stopped at the giving some definitions. What are the definitions we have given in last class relating to, I think, commitment? What is the commitment, and what is the cash flows will be happen in the fund, and what is the capital call, what is the contribution, what is the redistribution, contribution, recallable distributions, and what is the commitment and under commitment. These all are definitions was given in last video, and now we are continuing with the last class. So welcome to fund accounting classes. So the first topic we will discuss in this case is management fee, that is any income or any expenses. What is this income, or what is, for whom it is income, for whom it is expenses? So it is it is the expense in the fund. This is payable by all investors to general partners or fund houses. So the investors will pay to that fund houses. Means the investors, in the books of investors it will be the expenses, and where the fund houses it will be the income. And these expenses payable by the investor to these fund houses, and when they collect these expenses, means when they collect this income in, if you see in the fund house side, or if you see in the investor side, when we they need to pay this amount. So why these expenses will be there? Management fee is for managing the assets. So whatever they are given amounts na, that amount is managing by the fund house and investing on the shares, bonds, investments. So they are managing that assets and investing. For that management and investing, the investors must pay the fee amount. That investors will pay the fee the amount. That fee is known as management fee. Means it will be recorded as expenses, and this is generally paid in arrears, or in some cases paid in advance. So some cases they will become payable, and some cases they will pay in advance, same like as these expenses, prepaid expenses, after the accrual paying, or before they will pay in some cases. So after the period they pay, that is yearly, they will arrears will be there. Means this month salary will be payable in next month, and next month salary will be payable on next month. This is arrears base. And if you go for some cases, what they will pay na, this 3 month salaries they will pay before itself. It is like a paid has some advance. Now, on which amount this management fee will be collected, on what percentage they will taken? So if we go for this management fee, means in case of mutual fund and in case of hedge funds, this management fee will be collected based on the NAV, that is net asset value. What is this net asset value? Means assets minus liabilities will be the net asset value. On this NAV there will be some percentage, that 2%, 1%, 3%, whatever the percentage they will decided. Based on that percentage will be imposed on this NAV in case of mutual fund and hedge funds, but not to PE fund, that is private equity funds. In private equity it will be different. So firstly we will discussing on mutual fund and hedge funds. Mutual fund and hedge funds, they will based on the NAV they will calculate the in management fee. For example, if you have assets of the fund has 50 lakhs, and that fund has 10 lakhs liabilities, 50 minus 10, 40. On that 40, the percentage will be calculated. If it is a quarterly, the 2% is per annum na, by 4 will be calculated, it will become the per quarter. And after quarter, if you want to record in a monthly basis, you will divide by 2 into 1, you will get the monthly cases. This is normally the mutual fund or hedge fund cases. Management fee in case PE funds. So in case of PE funds, NAV will can also be zero or negative in first quarters, or they do not collect any amount from the investors. In PE funds, what will happen? They may be NAV. If you go for the NAV, it may be zero in some cases, or it may be negative in some cases. And even though at the starting itself they don't collect any amount, so whenever they need, they will collect. So that in this case, that is in case of PE funds, private equity funds, the management will be calculated on commitment amount. So commitment and the fee will be collected on commitment. We had discussed these terms before class itself. If you do not understanding the what is this commitment, you will see the last video, then you will get the all terms what I am discussing now. Commitment, distribution, redistribution, this all discussed in yesterday class itself. So come to the point. NAV will be calculated on commitment. Here, if a fund has what in yesterday's example we have discussed, Prabhas Darling was there and HB fund is there, he has given commitment of 100 crores. So on the 100 crores we will calculate 2%, and it will be for, it is a long term fund and they will invest in almost equity only. So it is a long term fund. So if it has a 10 years or 5 years, and 10 years we will calculate on commitment itself. Or sometimes, however, sometimes there may be some funds, some PE funds follow different types of funds, different types of method based on the funds, based on the negotiation between these general partners and that limited partners who are investors, and they will decide one method at the time of launch and they will continue to use that method. And sometimes they will go till the end, they will change in middle also, they will enter and they will agreed at the time of beginning itself. So how they will be calculated, how they will be charged. For example, if a fund is launched in 2020 and it will go up to 2030, they will tell that 5 years will be based on commitment and 5 years will be based on NAV. They will tell at the beginning of the fund itself. So how they calculated, and here the management fee amount they will collect now. And if the fund says any 2% on commitment or NAV, and it is payable for the fund manager efforts or time whatever they are putting their efforts, because of their time and their efforts are kept in the fund will be managing, so that this will be the expenses. So also all common expenses what they are incurred to manage the funds, like what are the expenses may be incurred for the team. So salaries to research team will be there, and a rent of office will be there. So salaries and rent of the office. In case of in the fund book, we do not see these expenses like salaries, rent, etc., since the fund will not have any employees or offer separately for that fund. So fund managers time and efforts and also common expenses they incur to manage the funds, they will charge. But in the fund books, we do not see these expenses like salaries, rent, since their fund will not have any employees or office separately for that funds. And we can only see management fee has major expenses in any mutual fund or hedge funds or PE funds, other profession fee like audit fee, etc. this will act as a intermediary, just this will act as a intermediary, and they will collect from that investors and they will pay to that main houses. And here the all the P's funds may follow same method or may follow different methods, may charge differently, because some funds will go in real estate, some funds will go in a startup, some funds will go in a infrastructure, some funds will go in a different way. So based on their efforts, based on their negotiation at the time of the launch, based on their time and based on the efforts what are taking, they may charge more fees for some fund, and they will find the better methods that will pay them more. So based on their time and effort they will collect the fee. So same all P's will not collect the same methods, they do not have any regulation to calculate the management fee in case of PE funds, and the this method only, they do not specify the any method. So they will change as accordingly whatever, and based on what is the reputation that companies have, that reputation what they are, and how the investors will be convinced based on the fee what they are taking, and what is their track record, means before starting their launch how the last funds they launched, how they gained and how they distributed. These all are the matters for paying the management fee and deciding the management fee they will decide. And they are here, they may decide based on their performance. So for these PE funds, what are the methods will be there for calculating the management fee, means one may be commitment based they may calculate, or one may be invested capital they may go, or one may be NAV based fee they may go, or one may be conversion method or switch based method, or one may be fixed amount per year they will choose. So there are different methods will be there. Here some methods will be, one will be commitment based, one will be investment or cost of investment method, and one will be NAV based fee, one will be conversion fee, and one will be fixed amount per year they will calculate. This is the case. If we go in the one method, so first method what is there, commitment based, we have discussed that commitment based. What is there in this commitment based method? In this method the fund will charge the fees to investors and their commitment from the beginning till close of or liquidation of the fund. So in our example what we have discussed, Prabhas Darling is there, I am the hedge fund, so hedge fund house, and here 100 crores is the commitment, and that 100 crores I will charge the management fee every year. So yes, in the fund manager means the efforts are there from the beginning to the fund and finding out the investment opportunities from the day one to at the end of the liquidations. So here there may be fund names, different fund names will be there, and different commitments will be there, and that they will calculate the 2% commitment on that case. And we have discussed one concept like vintage year. So vintage year, however we have the in accounting language we have financial year, if you go for the calendar year it will be start from January, and where the vintage year means in which year the fund begins. So vintage year means in which year the fund beginning year will be the vintage year, and fees will be calculated for the year. Same for the all years, generally they will calculate on quarterly basis and send the invoice. So how they calculate, quarterly basis they will calculate and they will send the invoices to that persons, and generally they will collect the fees on quarterly basis and arrears. If they arrear means what we are discussing, that is same like a salary arrears, first accrual after they will collect, or some cases in case they will collected in advance, they will send the invoice in that case itself. And after the commitment base, another method will be invested capital method. So in this method, investors will pay fee only on amount invested by the fund. So whatever the amount invested by the fund, on this fund invested year will be so fee amount can be less. Fee for the year is calculated below, or each time fund how invest some money, or fee base will increase. So first year it will invest, first year it will invest some 20%, and second year it will import 25%, and second year, third year it will go in a cumulative, and first year it will be 20 crores and second year it will be 40 crores cumulative amount. And this amount we will calculate because it is invested capital for first year and it is invested capital for second year. So second year it will become 40, and after that if we go for another 20, third year will be 60 crores. So it is invested capital, it is investing based on the case. Here the calendar year will be come into the picture, and numbers maybe in US date formats will be there. So if you see in India, we will follow the date structure. The date will be there, after that we will write month, after that we will follow the year. But when we go for the US date, and these funds are almost in US based, no, so they will follow the date structure will be month, after the date, after the year. So don't confuse by seeing this. So it is Indian based, it is USA based. In India we will follow date, month, year structure, and where they follow month, date and year, that is the case. And here whatever the amount they will calculate, and whatever the amount they are invested, and that investment they will calculate. And here the person who is having the general partners will have negligible amount whatever they will. Here if the fund is allowed to take any borrowing or leverage capital, then total investment can be more than the commitment, then total fee can be more than the commitment basis. For example, if we are committed 10 crores and borrowed company 5 crores, so it is commitment amount, it is borrowed amount. Now total amount will be become 15 crores, and so mostly the fee amount will be in this is fund will be for 10 years. If you think 10 years will be more than the committed base. Even if they will invest in from this 15%, they will invest 30% in first year, 20% in first second year, they will invested by second year, third year. So if no leverage or borrowed amount is allowed, then the fee earned by the general partner will be less in the method, since all the committed amount will not be invested at a time. So the problem of the investor is there. So they are making this general partner to invest all money soon to get the fee revenue, so they may invest money without proper research, and that may give the lower return on investment. So what happen if we go for the invested capital, these general partners will go invest in wherever they want. They will firstly invest because they will get the more revenue. So it is not allowed. So if no leverage is there, then fee earned by that GP will be less, and all the committed amount will be the invested is problem. So if you forcing the one person, forcing to one person, he will do what can be, he will do in stress feel or pressure feel, they may not think the good side, or they may not have the proper time to get what is right or what is wrong. So if they think in a wrong way, and they will go in a faster way, and they may put that all amount in some investment without proper research, and by investing they will get the amount of revenue. And after the method will be NAV method. NAV method. In the NAV method, in this case, there similarly that mutual fund and hedge funds is there na. PE fund also charged fee based on NAV of the fund. Here NAV was standard by net assets value. What is this net assets value? Asset minus liabilities. So asset 1 crore is there, asset 1 crore is there, liability is 10 crores is there. 1 crore 10 lakhs, I think better, 90 lakhs will be the NAV. On this NAV we will calculate the management fee. If the fund is charging fee on quarterly basis, they will collect in Q1 in April. So first quarter amount, that is January to March quarter fee amount, they will collect April basis, because it is in accrual basis. Sometimes they will not have NAV number ready to bill the management fee, because this is private equity na. So sometimes they do not have a NAV to bill the management fee of that quarter. So they will use the latest NAV number available to bill provisional management fee, that is temporary. Then the balance will be adjusted as true up or true down value. So some cases, if you do not have the NAV, they will take the latest NAV number whatever available at that time, and they will give the invoice in a provisional management way. So for example, if you want to write that fee invoice on 10th April, that is quarter 1 related invoice will be sent on 10th April. NAV of Q1 is not yet finalized for that quarter. Then what we can do, last quarter NAV, which we for January, February, March we do not have NAV, but last that December, November, October, last quarter NAV will be there na. From that NAV we will calculate and raise the invoice for the quarter 1, assuming Q4 of last year will be NAV of Q1 NAV. And after the finalization, if any different is came, the different amount fee will be adjusted in the next quarter fee invoice. That is NAV method. After that NAV method, we will go with the conversion method or switch based. That is conversion method. Switch based method means, in this case the management fee method will be changed from one method to other method over a period of time. So they will decide at the time for first 4 to 5 years. First to 4 years we will go with the commitment, and after the 6 years we will go with the NAV. This is switched, or this is conversion method. Here fee will be charged based on the commitment sum for 4 years, and next fee will be charged based on the invested capital or NAV. Here in this case the general partner will get time to research and make the investment in first 4 years, rather invest in a hurry, so to get more fees. So if you are making the research, the general partner hurry, they will invest wherever you want and you will get the fee amount. So but in this case, for first 4 years we are giving the fee on commitment, he will get the 4 years time and he will get the management fee properly. After that we will go for switch to NAV. It is also beneficiary, and he will invest better funds, better stocks. And here the investment period means the fund should complete the investment activity within this time. So if we are entered for 4 years commitment based, after 6 years NAV, so that GE person must complete his research and invest in within this 4 years only, and fees will be based on the commitment, and later it will be go for NAV, or if you think on invested capital. And after that, we do not want any disturbance, we will go with the fee. Fixed fee. In the fixed fee, they will fix the fee in first year 5 lakhs, first year 5 lakhs, and second year it will be 10 lakhs, and third year it will be 20 lakhs. So they will fix the fee amount at the time of year only. And these investors are general partners negotiate certain terms mainly based on the efforts of the general partner or risk taken by the investors. And here they may go for some adjustment. In this case, the fund will charge lower fee over a period if the fund manager's efforts are expected to be less in the later part of the fund's time. So normally the effective rate will be 2% will be there. Normally effective rate will be 2% will be there. And they will discuss how they discuss now. For first year we will pay 2%, first 3 years we will pay normal rate. After the from fourth year to fifth year, sixth year we will pay 1.5, and after that we will pay 1.125%. After that we will pay some percentage. So they will discuss as like as whatever they want. So because first to 4 years only the efforts will be required for the general partner, after that it will be just operating na. Why we should pay that much amount? So they will fix that fee percentage. And sometimes the fee amount will be in tier based fee. A type based fee means fee from the investor will be differently, mainly based on the amount they invested. So investment by the investors. So if the investors invested up to 10 crores 1 percentage, up to 100 crores 1 percentage, and above 100 crores to 500 crores one amount, and above 500 crores 1 percentage. So they will discuss it in the tier based fee. In some cases these all are will be get in a side letters. The side letter means LPA terms. That is LPA terms apply to all investors in the fund. And if the fund want to give any some exception to one or set of investors, they can enter into the separate agreement, or that is side letter with them. So all person whoever is there, this investors will have same terms for as per LPA. If any person want some exception, so if this person wants some exception, he will enter the separate agreement, and that separate agreement also known as side letter. So siding this person, that is side letter. If any one fund is there and they are charging 2% to all investors, so for all 2% is charged. The fund is launched in second fund. So if the fund is launched in second fund, if the investor from fund 1 also invested, so second fund is there, this one person is invested in same fund house in second fund. So to give some gratitude, they will giving some discount because he has already invested in our company's fund 1 and he want to invest in fund 2. So in fund 2 all persons will charge 2%, but this person will charge some discount percentage, and in this person will enter with separate agreement, or we shall call as side letter. And fee free to investors. Some cases some investors in the fund will not pay fee because they should exclude from the fee for calculation. Who them characters investors will not pay fee because this general partner general partner general partner will not pay the fee amount because he is working as a working for the fund, and if he taken any amount, it is what happen, he is investing and he only taking, and he only paying and he only taking. So if he pay any management fee to fund and he is working that fund and he will get the salary, so giving in one hand and taking in one hand, it is not a good practice. So for that calculation, we will exclude this general partner or carried interest partners will be there, and employees of the fund house. If any employees is there, the fund house is also same persons. They are investing, they are paying management fee and they are getting salary. It is not a good practice. And here carried interest partners will be there. And whereas some, this is all about the management fee. Some cases we need to pay the performance fee also. Performance fee or carried interest or incentive fee, or we also known as performance fee, or we waterfall provision will be come into picture. We are introduced to this waterfall provision in back class only, at the time of I think LPA time we are introduced, I think so. If for income distribution we will discuss the income will be distributed in a waterfall, I still na in this case. So if we go into the private equity and hedge funds, there are common practice to share the profits with general partner and fund house if they generate some good returns in the fund, and they generally normally management fee will be there. Management fee will be fixed, it is fixed, but they generate more good returns, and on that profit they will pay 20% or 10% based on the performance they are giving to the fund. For example, if your fund house invested 100 crores in the fund and it gave the return same as 100 crores, so it is not that much easy whatever amount invested and whatever getting the return. Now you need to pay the management fee, 2% is normal cases, but you have got this because they done the more efforts, so we need to pay the incentive, or we need to pay the performance based 2% or 10%, 12%, whatever the percent they will decide this percentage of sharing in profits, and whether to have this incentive fee in the fund or not, etc., are decided by the investors and general partners based on the negotiation at the time of the launch, and include these terms also in that LPA. Without having in LPA, they do not get any performance based or incentive fee at the during the terms, and these terms must be included in LPA hierarchy. We are discussing cash flow distribution in the fund, and this cash flow distribution we known as waterfall provisions. Waterfall provision means simply for waterfall provision means here first the senior management level some percentage, and after that juniors will get, means water, how can the water will flow in cash flow also will be there in these cases. And most commonly hierarchy of cash flow distribution is they will pay that amount to 100% on principal to the investors, that is this limited partners, and where the general partner portion will be also invested, and remaining cash whatever the cash will be there and pay to investors as preferred return. So at the time of launching the fund they will give certain percentage, has some they will give generally prefer some returns, so 10% or 8% something. So whenever they got amount firstly, and the principal amount 100% pay to first LPs and GPs, and after that remaining cash will be payable to investors whatever the returns preferred. And after, if there is any cash is remaining, then general partners will come again and they will prefer returns in second step also. Here what will do na, first 100% will get by the general partners and LPs on invested amount, normal cases, and after that investors will get the whatever the return, normal return will be payable. If after, if their cash is remaining, then this general partner will catch up some percentage, and of any preferred return he has paid. And if there is remaining cash, then they will share the ratio between this GP and LP. And here the company fund houses will be there, because waterfall provision means here cash was flow in a way like a water. Firstly, for the 100% invested amount is there for GP and LP, so that they will get the return on that invested amount. After that investors will get amount, and we are, because he is working for the fund, he will get some return. After that remaining cash will get the general partners and limited partners in a one ratio, whatever the ratio they will decide, 20 is to 80 or 60 is to 40, whatever the ratio they will decide. Based on that ratio they will get. And this waterfall methods, we have in industry two methods will be there. One is in American, one is in American, one is in European water method. So European waterfall method means, this is most common method used in the method. This is better for the investor side, who will get better here, investor will get better in European waterfall. And here in this case the cash will be distributed, should be based on whole of fund numbers rather than investment by investment number. So this is deal by deal side. What will happen? European waterfall method means they are most commonly used methods for better for investors. For the, in this case cash will be distributed based on the whole fund number rather than investment by investment number. If we see in mutual funds, the investors will be more, because the amount investing is less amount. You can start the mutual fund at 500 rupees also, so number of investors will be high. So if you go with the investors number, it will amount will be more, so that they should not go by number, they will go with the whole of the fund. And if investor is invested some 500 crores, and fund invested in two companies, and one is H company and one other is M company, and the fund should return all these principals and prefer return to all investments, that 500 crores whatever they carry. And if they sell any one investment in any year, and if they made any profits, they still they cannot take carry all this amount if not paid to investors. So if it is means whatever the whole fund is existed, on that whole fund the amount, the cash will be distributed. So how the cash will be distributed, we are discussing in before itself. 100% firstly for this GPs and that LPs, after that investors will give, after that general partner will get, and after that general partner and limited partners in the proportionate ratio. So this is waterfall. And what is the waterfall method? That amount will be required now for cash distribution, remaining cash we are using. That cash how they take, for European waterfall method one, and another one will be American waterfall method. So in European waterfall method, that there will be whole on based on the whole fund, and where if we go for the American waterfall method, American American waterfall method, if you go for this American waterfall method, they can take carry by selling one investment also if the investment give good returns. So here if you go American waterfall method, he is more helpful for general partners. So if you see European waterfall method is better for investors, but whereas American waterfall method is used for more beneficiary for general partners. Here the deal by deal carry can be calculated and distributed to general partners. So here if we sell one investment in 5th year or 6th year, then the general partner may get carry if the investment give the profits. So in the last example, in 5th year they are sold one asset, and after the sale, even though that sale get any profit, the person will not get any amount. But in American waterfall, if we sell one asset, if we get any profit on that asset, then this GP will get some amount on investment giving the profits. So for example 100 crores is there on this invested in H fund and M fund, this 50 crores and 50 crores. Here we are sold, we are sold this 50 crores H for 80, this is 30 the profit, and now the fund exists, total fund will be 50. So if we go for European waterfall method, this on 50 only they will calculate, but if we come in the American waterfall method, in this 30 what they are got the profit, they will get some revenue on this amount. Here general partner take carry on that profits. If they invested some amount in anywhere, and if they sold some amount, they will loss, they will not carry on that. If we 50 they sold for 40, means they get 10 loss, they will not carry any amount. Here the GP will get when the assets were sold for profits. If the asset was sold for loss, he will not take that loss in these cases. So that's the reason we will use the European method in most scenario cases, and in next class we will discuss more.